Welcome to the Explainer. You know, if you've ever been told to get out of debt as fast as humanly possible, well, for the average person, that advice makes perfect sense. But here is a completely counterintuitive reality. It's the exact opposite of what wealthy individuals actually do. Today, we're going to break down the fascinating architecture of evergreen debt. The absolute wealthiest people in this country are often the most heavily leveraged. They don't run from debt, they embrace it. They use it as a permanent mathematical tool to build and protect their fortunes across generations. So in today's breakdown, I'm going to show you exactly why banks love this arrangement, why the math works so incredibly well, and why this strategy is completely different from the kind of debt most of us carry around in our wallets. Real quick, before we get into the nuts and bolts of how all this works, just a reminder that everything we cover today is strictly for educational purposes. We're exploring financial architecture here, so definitely don't take this as personalized financial advice. Okay, let's dive into this. We are constantly told that debt is a financial anchor, right? Society basically tells us it drags you down, it limits your freedom, and you should aggressively pay off everything from your mortgage to your car to your student loans as soon as you possibly can. And yet when you peek at the balance sheets of the ultra-wealthy or you read the financial disclosures of major CEOs, you routinely see massive, staggering amounts of leverage. Why is that? Well, because the conventional wisdom to pay off debt fast almost always refers to a very specific kind of debt. To truly understand how the wealthy operate, we have to completely shatter the myth that all debt is created equal. Section 1. Two totally different kinds of debt. Because conflating all debt into one big category is exactly where most people get tripped up. Now, what's really interesting about this slide is the stark contrast between these two worlds. On one side, you have your consumer debt. Think credit cards, personal loans, those high-interest auto loans. This debt funds depreciating purchases or just everyday lifestyle spending. It carries notoriously high interest rates, and crucially, it doesn't generate a single dime of income or future wealth for you. But on the flip side, you have asset-backed debt. These are loans secured directly against appreciating assets, like a massive stock portfolio, commercial real estate, or private business equity. This is the playground of wealthy borrowers, and mechanically, it operates in a completely different universe than your everyday credit card. Section 2, Why Borrowing Actually Beats Selling. Let's look at the strict, unemotional, mathematical logic behind why cashing out is often the absolute wrong move. Let's ground the math in a concrete scenario. Imagine an investor. Maybe they're an early tech company employee or someone who's just held on to legacy blue chip stocks for decades. And they have a $20 million portfolio. It's grown significantly over the years, which means most of that $20 million is pure profit. Suddenly, they need $2 million in cold hard cash, maybe to buy some real estate, fund a brand new business venture, or just make a major lifestyle purchase. They basically have two choices. They could just sell $2 million worth of their stock. Sounds simple enough, right? But there is a massive, incredibly expensive catch to doing that. And that brings us to a really vital piece of vocabulary you need to know. The SBLOC, or securities-based line of credit. Instead of hitting that sell button, the wealthy borrower takes out a loan using their stock portfolio as the underlying collateral. They get their $2 million in cash, but they never have to trigger a sale of their actual assets. Let's look at the math side by side to see why this is so remarkably powerful. Option A is selling the stock. When you sell highly appreciated stock, you instantly trigger a capital gains tax. Selling $2 million worth of stock could literally mean losing hundreds of thousands of dollars straight to federal and state taxes, depending on where you live. That is wealth permanently gone. But look at option B. Borrowing that $2 million via an SBLOC is not a taxable event. The IRS taxes income and realized gains. They do not tax debt. The $2 million they receive is just a loan. So, as long as the interest rate on that loan is lower than what they would instantly lose to the capital gains tax hit, which is almost always the case, borrowing is mathematically superior. Plus, for multi-million-dollar accounts, private banks offer incredibly competitive rock-bottom interest rates just to win their business. Section 3, the evergreen debt loop. Let's shift the narrative behind the curtain for a second to examine the banking industry's perspective and why they eagerly facilitate these loans. The private wealth management industry rarely advertises this loudly, but it all comes down to simple, airtight business logic. First off, it's an incredibly low-risk loan for the bank. That $20 million highly liquid stock portfolio is sitting right there in an account they control as collateral. Second, it creates a recurring revenue relationship. A wealthy client who never sells their assets, keeps borrowing, and keeps their massive portfolio invested with the same institution, that is the ultimate high-value client. They generate steady interest income and frequently pay hefty fees for wealth management services too. But the third point, this is the real kicker. The client has absolutely no incentive to ever pay off the full balance of the loan. Think about it. Paying off the principal in full might mean having to actually sell assets to get the cash, which triggers the exact tax event they were trying to avoid in the first place. So the loan just continues. It becomes evergreen. The interest gets paid, sometimes the loan gets refinanced against a larger portfolio, but it rarely ever gets completely closed out. Let's move to and see how this builds into one of the most famous strategies in ultra-high net worth finance, casually known as buy, borrow, die. Step 1, you buy appreciating assets or build a company that becomes one. Step 2, you borrow against those assets tax-free for your entire life, using an evergreen credit line to fund your lifestyle. Step 3, and this is where the gravity of the strategy really hits you, you pass the assets to your heirs when you die. Under current estate tax rules, the cost basis of those assets actually resets upon death. This is known as a stepped-up basis. It means decades of massive, unrealized capital gains can potentially be wiped out entirely from a tax perspective. The heirs inherit the portfolio at its current market value. They can then sell a small portion of those newly stepped-up assets to pay off the outstanding loan, completely tax-free, and keep the vast majority of the fortune perfectly intact. Section 4, when the strategy fails. Because as fascinating and mathematically elegant as this all is, we have to responsibly pivot here. This is not some magical, risk-free money glitch. So the crucial point is understanding the terrifying reality of margin calls during a severe market downturn. FINRA, the Financial Regulatory Authority, has an explicit investor alert about securities-based lending. It clearly states, if the value of your securities declines, the firm can sell your securities without contacting you. Let that sink in for a second. If the market crashes, the bank is going to protect its own capital first, and they absolutely do not need your permission to do it. Here is how this unravels in practice. Imagine a severe market downturn, like the 2008 financial crisis, or a sudden, brutal tech stock crash. The value of that collateral portfolio plummets. The bank instantly issues a margin call, forcing the borrower to deposit more cash immediately to secure the loan. If the borrower can't, the bank forces the sale of the underlying assets at the absolute worst possible time, locking in massive, devastating losses. We've literally seen instances of high-profile, over-leveraged tech founders who pledged millions of shares for personal loans, only to have their portfolios entirely wiped out when their company stock tanked. On top of that, these loans aren't fixed forever. Many have variable rates tied to the broader economic environment, like the Fed funds rate. When rates rise rapidly, the cost of carrying that debt shoots up, squeezing the borrower. So finally, remember, this entire architecture really only works safely at a massive, highly liquid scale. For most regular people, taking on aggressive debt against a limited, concentrated stock portfolio is basically financial suicide. Section 5, Lessons for Regular Borrowers. So, what does this all mean for you and me, pulling the curtain back on the ultra-wealthy? Well, the ultimate takeaway here is deeply internalizing the fundamental difference between good leverage and bad leverage. Debt that's used strategically to fund an appreciating, income-producing asset is a completely different financial instrument than debt used to fund a lifestyle you simply can't afford. Good leverage builds wealth over time. Bad leverage actively consumes it. And this brilliantly illustrates our second lesson: selling an asset is not always the best or the only way to access its stored value. Everyday homeowners use this exact same billionaire logic when they utilize a HELOC, or home equity line of credit. Instead of selling their family home and moving just to get cash for a major renovation or a sudden emergency, they borrow against the equity they've carefully built up. The mechanics of this asset-backed debt are incredibly similar to the SBLOC. They get the utility of the cash while keeping the appreciating asset. Which leaves us with a final, slightly provocative question. Is being entirely debt-free always the optimal goal? The reality is, the utility of debt depends entirely on who is using it, what it is backed by, and what it costs. For some people, paying off every single cent is absolutely the right path to peace of mind. But for others, effectively managing low-cost leverage is the specific key to unlocking generational wealth. It's wild to think about, but the exact same word means completely different things in different contexts. Again, remember that all of this is educational content only, and you should always consult a licensed financial advisor to look at your specific situation. If this breakdown helped clear up the mystery behind how the wealthy actually use debt to their advantage, make sure to subscribe for more deep dives just like this. And hey, let me know in the comments, would you like a dedicated explainer specifically on how securities-based lines of credit work step by step? Thanks so much for learning with me today, and I'll catch you in the next one.